Hello, everyone. I am Mark Kinney, Chief Investment Officer of Newport Private Wealth, with this first quarter update. To start, I'd like to recap the three primary goals that guide us. Protect your capital first and foremost, produce steady income, and provide growth to protect and enhance your standard of living. How we achieve these goals is rooted in four essential elements. 1, proprietary thinking by our investment committee, the 10-person team that sets strategy and asset allocation. 2, diversification. We draw from 12 different asset classes to construct portfolios. 3, we have access to unique private investments that stabilize returns. And 4, we retain independent specialist money managers to ensure we have the right expertise in each asset class. So how did these principles relate to our activity in the first quarter? We had a decent start to the year, and portfolios are set up for what we expect will be more volatility, judging by the past 6 months. After the worst December in market history, both bond and stock markets came roaring back to life in the first quarter. In our view, both extremes were overdone, and they act as a reminder for both a sound strategy and diligence. In the first quarter, our focus on protecting capital was a short-term drawback relative to the benchmarks. Our two equity funds held about 25% cash and private investments, so we didn't have 100% exposure to the public market rally as the benchmarks do. Similarly, in bonds, our short-term duration and emphasis on high-quality issuers is more conservative than the index and therefore lagged a bit. However, the fact that we protected capital when the market sold off in December meant we didn't have as much ground to make up in the recovery. We simply don't need to take on as much market risk to earn an attractive rate of return and meet our three primary goals. Minimizing downside while capturing most of the upside is how we outperform the benchmarks after fees over a full market cycle. We also believe the first quarter will ultimately be characterized as a short-term recovery from an overdone sell-off rather than a sustainable economic event. As a result, we made the decision to further de-risk our portfolios as global economic growth appears to be slowing. If this is correct, you can expect to see some major adjustments to the long-running bull market. We don't want to be overexposed late in the game. So, we've been taking profits on some equity investments and reducing exposure to the value component in our North American equity fund, as it's been more volatile than we're comfortable with. During the first quarter, we also made a new investment that I want to describe to you. Although not large, it's a good illustration of our access to private alternatives and specialist managers and the work of our investment committee. We invested $20 million US in a private fund of energy infrastructure assets, pipelines, storage facilities, energy gathering systems. In other words, the critical underpinnings that energy companies need to get their products to market. So why this asset class, why now, and why this manager? First, we like private infrastructure as an area of investment. These types of assets are not linked to the public markets and therefore not subject to the same volatility. They provide steady income and, in this case, represent an opportunity to earn outsized capital gains with downside protection. Why? One reason is timing. As you're no doubt aware, the energy industry has been out of favor since the collapse of oil prices in 2014. Traditional means of financing have either dried up or become more expensive for energy companies, thus opening the door to alternative funding sources on very attractive terms for investors like ourselves. Another reason is the fund manager's creativity and capability in structuring their deals for downside protection. As one example, approximately 10% of the energy fund is invested in two major pipeline construction projects in the Permian Basin, the fastest growing region for shale oil production in the U.S. It also happens to have a shortage of pipeline capacity. To minimize our investment risk, the fund manager brought in three major oil companies as minority equity investors and signed long-term contracts to lock them up as customers, thus ensuring their commitment to the pipelines once completed. The fund's management team has done more than $7 billion of energy-related investments and has a very good track record. We've had success investing with this firm for several years, though not in the energy sector. This is an institutional-only investment with a small number of investors participating. The fund's management team have also put up $75 million of their own money into the fund. I think that's evidence of how much they believe in it. As part of our due diligence, our investment committee went into the manager's data room and reviewed all their work to verify how they reached their investment decisions and to satisfy ourselves their thinking was sound. I want to thank my colleague, David Cole, who led this, and our team for their excellent work on it. In a nutshell, this investment is a private, opportunistic play on the undervalued energy sector, with major capital appreciation potential, protected downside, and minimum sensitivity to oil prices. We're targeting annual returns of 15 to 20% over the next 6 to 8 years from this investment. In closing, we believe our portfolios are very well positioned for whatever the market throws our way. I often tell people we're like Goldilocks. If the markets chug along, we'll provide a good rate of return. If they correct, we have lots of protection through our diversification in private assets and cash that will cushion us and allow us to reposition at better valuations. We are comfortable with our positioning and hope that these communications help you to be as well. We can never say it enough. Thank you very much for entrusting us with your family's assets to manage.